In late 1989, based on the per-meter price of surrounding commercial districts, the grounds of the Imperial Palace were estimated to carry a higher theoretical value than all the real estate in California combined. Not Tokyo, not Japan. A single palace compound. 1.15 million square meters of land in central Tokyo, surrounded by moats and stone walls, home to the emperor. Financial analysts calculated this theoretical value using nearby Ginza commercial land prices. The numbers came out between $850 billion and $1 trillion for one property that would never be sold. The Chicago Tribune reported this calculation that November. It was not an official appraisal. No one was actually buying or selling the Imperial Palace. The number was a thought experiment, a way of illustrating how disconnected Japanese land prices had become from any recognizable reality, and almost everyone who heard it shrugged and kept buying. By 1990, Japan's Economic Planning Agency estimated the aggregate market value of all Japanese land to be roughly 4 times greater than the total land value of the United States. A country smaller than California, with fewer natural resources, supposedly worth 4 Americas. Tokyo commercial real estate had risen 57% in a single year. At the peak, memberships at the most exclusive golf clubs, such as the Kogane Country Club, traded for prices exceeding $3 million. One membership. To play golf. The Nikkei stock index hit 38,915 on December 29th, representing 41% of all equity value on Earth. And within 3 years, the Nikkei would lose 63% of its value. Land prices would fall for the next 29 years. The economy would stagnate for 2 decades. An entire generation would enter the workforce during what economists now call the lost decades. This wasn't irrational exuberance. It wasn't tulip mania or dot-com speculation. It was structural. A self-reinforcing feedback mechanism, often described as a collateral loop, allowed rising land values to justify larger loans, which were then used to purchase more land, driving prices higher. The same mechanism, running in reverse, amplified the collapse into synchronized catastrophe. Understanding how it worked explains why Japan's bubble was so extreme, why the crash was so severe, and why the recovery took longer than anyone predicted. The story starts with 5 men in a hotel room in Manhattan. A decision that seemed reasonable at the time. September 22, 1985. Finance ministers from the United States, Japan, West Germany, France, and the United Kingdom gathered at the Plaza Hotel in New York City. The Reagan administration had a problem. The American trade deficit had ballooned to over $100 billion. Factories in the Midwest were closing. Auto workers in Detroit were losing jobs to Toyota and Honda. The political pressure was intense. The diagnosis was simple. The dollar was too strong. American exports cost too much overseas. Foreign imports were too cheap at home. The solution the 5 ministers agreed upon was coordinated currency intervention. Central banks would sell dollars and buy other currencies, and the dollar would fall. The yen, the Deutschmark, the franc, and the pound would rise. The Plaza Accord worked faster than anyone expected. Within 8 days, the yen appreciated 10% against the dollar. Traders saw the coordinated intervention and piled on. By the end of 1987, the yen had risen 47%. The exchange rate moved from 240 yen per dollar to 128. For American manufacturers, this was relief. For Japanese exporters, it was catastrophic. Consider a Toyota factory in Nagoya. The cars rolling off the line cost the same number of yen to produce. But when those cars shipped to America and sold for dollars, those dollars now converted back to 47% fewer yen. Profit margins evaporated overnight. Sony televisions, Panasonic electronics, Honda motorcycles, Nikon cameras. Every Japanese export became dramatically more expensive in foreign markets. The newspapers called it Endaka Fukyo, the strong yen recession. Export-dependent companies started announcing layoffs. Industrial production slowed. The political pressure shifted to the Bank of Japan. Do something. Stimulate domestic demand to offset the export collapse. The Bank of Japan faced a choice. Let the export sector contract and hope domestic consumption would eventually compensate, or cut interest rates aggressively to stimulate borrowing, investment, and spending at home. Governor Satoshi Sumida chose stimulation. He cut the discount rate 5 times in 13 months. In January 1986, the rate moved from 5% to 4.5%. In March, it went from 4.5% to 4%. In April, it fell from 4% to 3.5%. In November, it dropped from 3.5% to 3%. In February 1987, the bank cut the rate from 3% to 2.5%, a record low for post-war Japan. Then, the Bank of Japan held it there. For 27 consecutive months, from February 1987 to May 1989, the discount rate stayed at 2.5%. The official rationale was straightforward. Consumer price inflation remained stable at around 1%. By the standard metrics policymakers watched, there was no overheating, no reason to tighten. What they were not monitoring was asset prices. What they were not measuring was the wall of money building up in real estate and stocks. In 1987 alone, Japanese land and stocks generated $3.4 trillion in capital gains. To put that in perspective, Japan's entire gross national product that year was around $2.4 trillion. Capital gains in 1 year exceeded total economic output by 40%. That money had to go somewhere. Interest rates were at record lows. Bank deposits paid almost nothing. It went into real estate. Tokyo land prices rose 10% in 1986. Then 57% in 1987, then another 23% in 1988. Some commercial districts in central Tokyo saw prices double in a single year. By the late 1980s, land prices in Tokyo's most expensive districts exceeded those of Manhattan by an order of magnitude. The mechanism driving this wasn't speculation in the traditional sense. It wasn't individuals flipping condos or traders gambling on momentum. It was something more systematic, something built into the structure of Japanese banking itself. Japanese banks operated differently than their American and British counterparts. In the United States, commercial banks primarily assessed a borrower's cash flow. Could the business generate enough revenue to service the debt? In Japan, the emphasis was reversed. Collateral came first, specifically land. Land was considered the ultimate safe asset in Japan. Prices had not declined since the destruction of World War II. 40 years of continuous appreciation. Banks loved land as collateral because it seemed to only go up. Corporate borrowers loved land because banks would lend generously against it. Here is how this feedback mechanism functioned in practice. A corporation owns a plot of land in central Tokyo worth 100 million yen. It approaches a bank and pledges that land as collateral. The bank lends the corporation 100 million yen. The corporation uses some of that cash to buy additional land. Other corporations do the same. Demand increases. Land prices rise. Now the original collateral is worth not 100 million, but 150 million yen. The bank's loan officers review their portfolio. They see collateral that has appreciated substantially. The original loan is now backed by 50% more value than when it was issued. The bank offers the corporation additional credit, another 50 million yen. No new cash flow analysis required. No updated business plan needed. The appreciating collateral itself justified the expansion. The corporation takes the new loan. It buys more land. Or it invests in stocks. Prices rise again. Collateral appreciates further. The bank extends more credit. The cycle repeats. This wasn't a flaw in the system. It was the system. Land was the foundation of Japanese corporate finance. Banks competed aggressively for corporate clients by offering the most generous terms against land collateral, but this feedback mechanism had accelerators built into it. 3 technical features of Japanese financial regulation made it more powerful. The first accelerator was Basel I. The international banking regulations adopted in 1988 allowed Japanese banks to count 45% of their unrealized gains on stock holdings as Tier 2 capital. When the Nikkei rose, Japanese banks didn't just feel wealthier, they became better capitalized by regulatory standards. Higher capital ratios meant they could lend more without violating international rules. Stock market gains fed directly into credit expansion. The second accelerator was window guidance. The Bank of Japan didn't just set interest rates. Through a practice called Madoguchi Shido, it also set quarterly lending quotas for major banks. Each quarter, loan officers received targets from Bank of Japan officials. Your bank should expand its loan book by this percentage. These weren't suggestions. Banks had to find borrowers. When rates dropped to 2.5%, finding creditworthy borrowers became harder. Real estate developers who wanted to build speculative projects became easier targets. The third accelerator was cross-shareholding. Japanese corporations owned each other through the Keiretsu system. Banks held substantial equity positions in the corporations they lent to. When stock prices rose, 3 things happened simultaneously. The banks saw their Tier 2 capital increase. The corporations they lent to saw their collateral appreciate, and the bank's own equity portfolios generated gains. Everything moved together. The system had no natural hedge. If you want to understand the mechanics of economic history, subscribe. This series maps the architecture of power systems. By 1989, 55.3% of all Japanese bank lending was backed by real estate collateral. That was up from 46.7% in 1980. The entire banking system was leveraged to land prices continuing to rise. Some banks were lending more than 100% of appraised property value. They might assess a building at 1 billion yen and lend 1,050 million yen against it. The assumption was explicit. Prices would keep rising. The collateral would catch up. It always had. In later retrospective analysis, Bank of Japan economist Shigenori Shiratsuka identified a critical structural vulnerability in asset-based lending during the bubble period. When the profitability of businesses financed by secured loans is closely related to collateral value, such loans become practically unsecured. Profits and collateral move in the same direction. If your income depends on land prices staying high and your loan is secured by land, nothing is actually secured. You can only repay if prices keep rising. The collateral only covers the loan if prices don't fall. The entire system assumed perpetual appreciation. The Nikkei hit its all-time high on December 29, 1989. 38,915 at the close. Japanese stocks represented 41% of global equity market value. 4 days earlier, the Bank of Japan had raised interest rates for the 4th time that year. Yasushi Mieno became governor of the Bank of Japan in December 1989. He was 65 years old, a career central banker, and deeply concerned about asset prices. He believed they had become dangerous. He intended to bring them down. The rate increases had started in May 1989 under his predecessor. Rates moved from 2.5% to 3.25%. In October, they reached 3.75%, and in December, they hit 4.25%. Mieno continued the campaign. In March 1990, the rate was 5.25%. In August 1990, it reached 6%. The discount rate had more than doubled in 15 months. But the decisive blow came from the Ministry of Finance. On March 27, 1990, the Ministry of Finance issued a directive called Total Volume Control for real estate loans. The rule was simple. Real estate lending growth at any bank could not exceed that bank's overall loan growth. If total loans grew 5%, real estate loans could grow no more than 5%. It was surgical. One regulation, one sentence. It cut the fuel line to the feedback mechanism. Banks could no longer expand real estate lending independently. They could not offer new loans against appreciating collateral if their overall loan growth was slow. The mechanism that had driven prices for 5 years stopped functioning. The feedback mechanism works in reverse. It simply operates in the opposite direction. Land prices stop rising. Collateral values stabilize. Banks cannot justify expanding credit based on appreciation that is not happening. The Ministry of Finance regulation prevents real estate lending from growing faster than other loans. Credit to the property sector. Freezes. Speculators who bought land with borrowed money expected to refinance based on higher valuations. That refinancing is not available. They cannot roll over their debt. They have to sell. Selling pressure enters a market that had only known buying pressure for decades. Prices tick down. The collateral is now worth less than the loan. Banks demand additional collateral, or they call the loan. Borrowers who cannot provide more collateral are forced into liquidation. More properties hit the market and prices fall further. The Basel I rule that had inflated bank capital now deflated it. Stock prices followed land prices down. Unrealized gains became unrealized losses. Tier 2 capital shrank. Banks had to reduce their loan books to maintain required capital ratios. They stopped lending, not just to real estate, but across the board. Credit contracted to healthy companies that had nothing to do with property speculation. Demand collapsed. Land prices fell further. By September 1990, 9 months after the peak, the Nikkei had crossed below 20,000, a 49% decline. By August 1992, it reached 14,309, 63% below the 1989 high. Land followed the same trajectory. Tokyo commercial real estate fell 25% between 1991 and 1992. Osaka fell 39%. Nagoya fell 20%. And the decline continued, year after year, for nearly 3 decades. The capital losses between 1990 and 1993 reached 159% of Japan's nominal GDP. In 3 years, paper wealth equivalent to 1.5 times everything Japan produced in a year evaporated from balance sheets. Banks faced an existential choice: recognize the losses honestly, take massive write-downs, and face potential insolvency, or continue lending to troubled borrowers and delay the reckoning. Most chose delay. Economists call this zombie lending. It means extending credit to insolvent borrowers solely to enable them to service existing debts, delaying the recognition of losses. Banks kept struggling companies operating because acknowledging their failure would require acknowledging the losses on the loans. Capital that should have flowed to productive new businesses remained trapped in failing old ones. The banking system became an obstacle to recovery rather than an engine of growth. The final cost of resolving non-performing loans reached 86 trillion yen, 17% of GDP, spread across the decade from 1992 to 2000. Japan's banks did not truly recapitalize until the mid-2000s. Economist Richard Koo spent years studying what happened next. He called it a balance sheet recession. The defining feature was not declining output or rising unemployment. It was a fundamental change in corporate behavior. In a normal recession, companies cut costs, conserve cash, wait for demand to recover, then resume investing. In a balance sheet recession, companies shift their primary goal from profit maximization to debt minimization. They have too much debt. Their assets have collapsed in value. Their singular focus becomes paying down debt and repairing the balance sheet. Even when interest rates hit zero, these companies will not borrow. They use every yen of free cash flow to repay principal. It is rational behavior at the individual firm level. It is damaging at the macroeconomic level. The Bank of Japan cut rates to effectively zero by 1999. It did not matter. Japanese corporations had watched land prices collapse by 60, 70, even 80%. They had seen their collateral evaporate. Their objective was not growth, it was survival. When every company simultaneously adopts this posture, aggregate demand collapses. No one is borrowing to invest. No one is spending to expand. The central bank can provide liquidity, but it cannot force the private sector to use it. The government became the borrower of last resort. To prevent outright depression, Japan ran persistent fiscal deficits. National debt rose from 60% of GDP in 1990 to over 200% by 2010. It was the only way to maintain demand when corporations and households refused to spend. Japan maintained social stability throughout. Unemployment never exceeded 5.5%. The social safety net held. But growth essentially stopped. GDP in 2010 was barely higher than GDP in 1995. 15 years of near-zero growth. An entire generation entered the labor market during stagnation. Land prices did not show year-over-year increases nationally until 2018, 29 years after the peak. The Nikkei did not exceed its 1989 high until 2024, 35 years of recovery. The feedback mechanism was a structural design where incentives reinforced themselves. Banks were rewarded for lending against appreciating assets. Corporations were rewarded for leveraging those loans into more assets. Regulators watched consumer prices while asset prices compounded. Everyone was rational within their own frame. The system itself contained inherent vulnerabilities. When both the borrower's income and the collateral securing the loan depend on the same variable, nothing is actually hedged. Rising prices justify more lending. Falling prices trigger a synchronized collapse. The cost was not just the crash, it was the productive potential lost during 2 decades of balance sheet repair. An entire economy redirecting its surplus toward debt service rather than investment. The factories still ran, the workers still showed up, but the growth trajectory shifted permanently downward. Japan in 2025 is a prosperous, stable, technologically sophisticated society. But it never returned to the growth path it was on before 1990. A generation entered adulthood during stagnation, a demographic shift that policy struggled to address. The Imperial Palace still stands in central Tokyo. Its grounds remain serene, surrounded by moats and stone walls. No one discusses its theoretical value anymore. Next, how one man became so powerful that 3 presidents appointed him Treasury Secretary, and Congress tried to impeach him for it. If you are here for forensic breakdowns of how power consolidates, subscribe. That is what this channel does.